Listen up, guys. If you turn on CNBC or your standard financial news feeds right now, you will hear the same tired narrative. They'll tell you the AI bubble is popping, cloud growth is decelerating, and big tech is slashing capital expenditures. I am telling you right now, that is complete and utter garbage. The party isn't over. It just moved to a VIP room. Retail investors don't have the password to. While the average guy is panic selling his portfolio over red charts, the real smart, money, the massive institutional whales are quietly and aggressively loading up on a specific trio. I am talking about the neo-cloud mafia NBIS, Oracle, and CRWV. If you don't understand what these three are doing right under your nose, you are literally leaving your wallet wide open on Wall Street. So grab a coffee, lock in, and let's dive into the real facts. I've been up all night, scraping SEC 10K filings and tracking institutional order flow, so you don't have to. Just digest what I'm about to feed you. Let's do a harsh, unfiltered fact check. What the hell is actually happening beneath the surface? The mainstream media is obsessed with ChatGPT and flashy robotics. Let me tell you a secret. The guys writing billion-dollar checks do not care about the chatbot. They care about the plumbing. Oracle, NBIS, and CRWV are no longer just legacy software. They are the absolute landlords of the next digital decade. Let's look at the numbers, because numbers don't lie. According to Oracle's latest SEC filings, their cloud infrastructure revenue didn't just grow, it violently exploded, accelerating at over 50% year over year. We are talking about a legacy giant with a market cap pushing over $300 billion, scaling like a nimble Silicon Valley startup. Look at NBIS and CRWV. Their operating margins are sitting pretty at a staggering 35% and 42% respectively. In real money terms, for every $100 they take in, they pocket nearly 40 in pure operating profit. That is essentially a legal money printer operating in broad daylight. You're probably sitting there saying, but bro, AWS and Microsoft Azure already own the cloud market. You desperately need to upgrade your mindset. Think of legacy cloud providers like a massive, generalized public transportation system. It's huge, but crowded, generic, and you follow predetermined routes. What NBIS, Oracle, and CRWV are building with this neo-cloud architecture is completely different. It's a private, hyperspeed toll road, built directly from your corporate headquarters to your core data centers. They are mastering edge computing, combined with highly dedicated bare metal AI clusters. Instead of hauling heavy datasets back to a centralized server farm across the country, they bring the processing power directly to the data source. This completely eliminates latency. In the new AI economy, latency isn't a minor inconvenience. It is a catastrophic financial loss. When an algorithmic trading firm loses a millisecond, they lose millions. These three companies are selling the exact cure for that latency, charging an absolute premium. Why is this massive shift happening right now? Here are two raw scenarios explaining this violent rotation of capital. Scenario 1 is the AI bandwidth bottleneck. We've reached a breaking point where the physical infrastructure of the internet is literally buckling under the sheer weight of generative AI. You can buy all the NVIDIA GPUs in the world, but without specialized, high-bandwidth, liquid-cooled data centers. You just parked a fleet of Ferraris in a dirt driveway with no gas station. Oracle saw this coming years ago, building Gen 2 cloud regions optimized for raw, unadulterated networking speed. Meanwhile, NBIS and CRWV focused aggressively on localized edge nodes. Together, they are solving the single biggest bottleneck in modern technology. Scenario 2 is the harsh macroeconomic reality of interest rates. We are in a higher-for-longer rate environment, which fundamentally alters how corporations spend money. When interest rates were zero, companies bought massive, bloated bulk packages of AWS storage and didn't even use half of it. Now that capital is incredibly expensive. Corporate CFOs demand extreme, ruthless efficiency. The neo-cloud model allows these enterprises to deploy hybrid, highly tailored infrastructure. They are basically telling Fortune 500 boardrooms, stop paying premium rent for an empty digital mansion. Let us build you a custom, high-efficiency, smart home for half the operational cost. The enterprise market is eating it up, signing multi-billion-dollar contracts, while the media tells you tech is dead. So what's the bottom line? You have to understand the institutional intent behind the price action. You pull up your app, see NBIS or CRWV dip by 4%, and your immediate reaction is panic. But if you actually dig into the data, use Python and Pandas to analyze the tape, or understand how institutional order management systems like Neovest route trades, a terrifying story unfolds. Massive multi-billion-dollar hedge funds don't buy stocks by clicking market order on a retail app. That is amateur hour. They use the FIX protocol and complex algorithmic slicing, like VBWAP, to route massive buy orders through dark pools, intentionally hiding their footprints. When they want to accumulate a massive multi-year position, they allow the price to drift lower on lit exchanges. They let the negative news cycle run to trigger your stop losses. They want you to capitulate and sell them your shares at a massive discount. It is a cold-blooded transfer of wealth, from impatient retail traders to patient institutional giants. They are shaking the tree to see which retail monkeys fall out. Are you going to be shaken out? Or are you going to ride the coattails of the smart money? Who actually wins and who ends up crying? The ultimate victims will be stubborn legacy tech investors who think the 2019 playbook will magically work in 2026. If you are blindly holding dinosaur tech companies that failed to pivot to edge computing, your portfolio will bleed out slowly. The winners understand that during a gold rush, the real wealth isn't made by guys desperately digging for gold. It is made by the guys selling the pickaxes, the shovels, and the high-speed railroads to transport it all. Right now, ORCL, NBIS, and CRWV are laying down that high-speed rail. They are the tax collectors of the AI revolution. Look, guys, I get it. It is genuinely scary out there right now. You look at the macro data, inflation numbers ticking up, and your instinct is to hide under the bed, or pray your underwater bags magically recover. If I just wait, the government will lower rates and save my portfolio. Stop right there! Emotional hoping is a mathematically guaranteed way to go completely broke. You cannot afford to sit around waiting for the rain to stop. You have to coldly, aggressively, and ruthlessly calculate your next move. Look at your portfolio like a cold-hearted CEO looks at a failing division. If an asset isn't serving the new reality of the neo-cloud, supercycle, cut it loose. Take the loss, free up the capital, and deploy it where the actual growth is happening. Here is the exact action plan you need to execute right now. Stop obsessing over daily 5-minute charts. Zoom out. Start treating any unjustified, macro-driven dip in these 3 specific companies as a generational accumulation zone. I am not telling you to YOLO your life savings at the opening bell. Build a rigid, structured, dollar-cost averaging plan. Calculate their forward price-to-earnings ratios, based purely on cloud revenue growth. Set your technical entry targets. When the broader market throws a ridiculous tantrum over backwards-looking inflation data, you do not panic. You step in and you buy the fear. You act like the institution. Do not click away yet, because here is exactly what you need to track moving forward. Number 1, monitor Oracle's capital expenditure, allocated to data center construction in their earnings calls. If that CapEx number keeps scaling aggressively, the underlying demand thesis is intact. Number 2, track the operating margins of NBIS and CRWV like a hawk. As long as those margins hold above that crucial 30% threshold, it proves they have absolute pricing power. They are irreplaceable. Number 3, keep an eye on 10-year Treasury bond yields. If yields stabilize or pull back slightly, it gives all tech valuations massive breathing room, acting as high-octane rocket fuel for these highly profitable infrastructure names. The gap between investors who prepare right now and guys who blindly react to the news tomorrow is going to be astronomical over the next 3 to 5 years. It's the difference between retiring a decade early on, a beach, and working until you literally drop. So here is the deal. If today's deep dive helped you see through the matrix and gave you real, actionable value, smash that like button right now. Let the algorithm know we do pure, unadulterated market reality here. And listen, if you have any other stocks, confusing macro sectors, or crazy economic news you want me to dissect, drop it in the comments below. I will literally stay up all night, run the data models, check the facts, and bring the absolute truth to you in the next video. Make sure you hit subscribe and turn on the bell so you don't miss it. Let's get out there, stay cold, stay smart, and let's all get rich together. Peace.